Hello again from Core Wealth, and we are going to be talking about what happened in June 2020, and also I'll take a bit of time to cover what has happened so far this year. It's been quite an interesting year, both from an economic point of view and also from the markets, and we'll try and make some sense out of what has been happening, and then we'll talk about what we expect to happen into the future. We all know that we're still in the midst of the coronavirus, although that we have seen a shift over the last little while. Europe is starting to come out of the effects of its coronavirus and the lockdowns. We've seen America still, a lot of challenges there, still spreading strongly. Brazil similarly, South Africa similarly, India as well. But all of the countries are just battling with the challenge of how do we open up our economy but still protect lives as much as possible in terms of the medical side of things. Now, if we have a look at markets so far in June, in South Africa, we've seen the local stock market up strongly, almost up 8% for the month of June alone. We saw listed property bouncing very strongly, up even more than listed equity. Then on a global basis, emerging markets were the place to have been in June, where we saw emerging markets, stock markets running quite strongly. The developed markets not up as much, and as we saw the US struggling in terms of just the challenges with the coronavirus feeding into what was happening on the listed markets over there. So the first quarter was horrific. It was, if we look back to 2002, it was the worst quarter for listed equity in South Africa. It was the worst quarter for listed property by a long shot. Even balanced funds in South Africa, the worst quarter since 2002. Globally, we saw stock markets falling, some of them as much as 40% by the end of March. Fast forward one quarter and look at the quarter to the end of June, the second quarter of this year, and a complete turnaround. Listed equity in South Africa, the best quarter since 2002. Listed property, I think, was the third best quarter since 2002. Income funds, one of their best quarters, and the list goes on. Just emphasizing the importance of sticking to your strategies, even though markets are volatile. It feels easier now that the markets are up and many up higher than in many instances than they were at the end of March. The volatility we don't think is gone, and we'll still see volatile markets. What a lot of people are struggling with is to reconcile, as they say, Wall Street with Main Street. We've actually coined the term Pain Street, in that the economies are struggling, but there's been so much support and stimulus from central banks and governments to try and get economies going, and that, we believe, is what's driving markets, because they're looking through the challenges over the short term, the next sort of year to 18 months, and that's what they're pricing into shares at the moment. We'll take some time now to look at what we expect from markets into the future. In our modern day world, where there's lots of information available, it's easy to get confused with all the noise. Our job is to do the research to try and dig through that noise. And this next graph just shows you some expected returns from different asset classes around the world. It looks forward and says over the next 10 years in US dollars, what is expected from the different markets. And just a few things that stand out from this graph. The emerging market equities are definitely the most attractive place in terms of expected returns over the next 10 years. You can see on here emerging markets as a whole around a 10% return, and China equities also similarly quite high returns expected from that market. Developed market equities less attractive, and US large cap equities the least attractive in the equity space. Emerging market debt also looking very attractive on this graph as a different asset class, but quite attractively priced at the moment. Now, we would never put all of our eggs in any one single basket, but it does show you the type of tilts that are expected to give better returns over the next 10 years if one looks at this. Now, this wouldn't be something that you'd immediately think of if you looked at what's happening in the news at the moment, because a lot of the emerging markets are going through the challenges of coronavirus spreading. But from a longer term perspective, if you look at those markets, this is what we expect to see. So I've spoken about different markets, but each of those markets have their own currencies. If we have a look around the world at the moment, the US dollar is, in our view, too strong. We think that we could see weakness in the US dollar over the coming months. And we saw that with the South African rand at the sort of end of March, April. The rand went through 19 rand to the dollar. At time of recording now, second week of July, the rand is now below 17 rand to the dollar. If we have a look around the world, UK sterling looks cheap, so attractively priced. Some of the emerging market currencies also looking quite attractive at the moment, and as I mentioned, the dollar probably too strong as we sit here now. So put those together and you can create a very attractive portfolio both globally, from all the different markets and the different instruments, without having to buy into expensive assets. For our South African investors, if you look back over the last 5 years in particular, you would see that the average balanced fund, so a fund that's invested in equities, property, cash, offshore, the average fund has underperformed inflation. The big question many people could be asking is, will that repeat itself? If we have a look at valuations, if we have a look at the opportunities that exist both in South Africa and around the world, we don't expect that to repeat itself. The expectations for listed equity in South Africa, which derives a lot of its earnings from outside of South Africa incidentally, the opportunities that exist around the world that I've spoken about earlier point to the fact that the next 5 to 10 years we would expect returns in balanced portfolios to improve significantly and do a lot better than we saw in the previous 5 years. And this is just the conundrum that often we faced as investors. It's easy to look back and assume that what has just happened will repeat itself. And I hope that in this presentation we've given you some idea that most times it's exactly the opposite. That what's immediately happened often is different into the future, and that's why you need to stick to strategies. And it's really about understanding what's going to drive returns into the future. If you have any questions around your portfolio in particular or anything general you'd like to ask, please get hold of your advisor. We are semi-open in terms of our offices, but the advisors are all available on their cell phones. The business is fully operational, albeit most staff are working remotely while we are easing out of lockdown. You would have hopefully seen the email where we are building a database of businesses within our client base, and it's something that we just want to share with you, our clients, so that we can try and generate a bit of business activity for our clients from within our client base. So if you haven't filled that in, please do that, and hopefully it creates a bit of economic activity so that we can do our bit to get the economy going again. One of the challenges when things are tough is to see whether we can reduce our overheads, to cut our costs. And an area we've been quite successful in that regard has been with our short-term insurance. Sam and Rob are the two advisors who work with our clients on the individual and the commercial side in terms of short-term insurance. And if that's something you'd like us to have a look at, please do get hold of us, and we'd love to see whether we can help you cut down your short-term insurance costs a little bit in that regard. Thanks very much for watching, and we'll be on your video screens again in the coming month.